There are 5 particular IRS forms that the typical American senior born before 1965 has never once submitted throughout their entire lifetime, and every single one of them could be worth thousands of dollars returned directly to their pocket before July 30th. 5 forms sitting on the IRS website at this very moment, completely free of charge, accessible to every senior born before 1965, and almost nobody is taking advantage of them because almost nobody has ever been informed they exist. Before I go a single sentence further, I need to address the one biggest misconception right now because it is the precise reason most seniors click away and leave thousands of dollars sitting unclaimed on the table. Some people assume a video about IRS forms is exclusively for seniors who are struggling financially. So if they feel comfortable, they stop watching. Others believe it represents some advanced strategy only useful for wealthy retirees managing complicated portfolios. So if they live primarily on Social Security, they tune out. Both of those assumptions are entirely wrong. This list applies to every senior born before 1965. Whether your complete income consists of a single Social Security payment or you carry a pension, personal savings, and a home that has tripled in value, there is genuine money waiting inside these 5 forms with your name on it. The reason almost no one discusses these with you is straightforward. The IRS does not promote tax savings opportunities. Your accountant does not receive additional compensation for filing forms you could complete yourself. And the deadline genuinely matters. June 30th is not an arbitrary date. For several of these forms, missing the window means waiting an entire year to recover funds that are already legally yours. So today, I am covering all 5 individually in plain language. Stay through the very end because form number 5 carries the highest dollar value per month of anything on this list, and it is the one form almost no senior even knows exists. Here is the uncomfortable reality. The IRS will not call you to remind you to file these forms. Your tax preparer does not automatically include them in a standard return. Every form on this list either lowers what you owe or speeds up what you receive back, which means the systems designed to collect your money carry little motivation to speak up on your behalf. Every dollar you fail to claim stays inside the system. That is simply how a passive tax code works. It rewards people who know to act. It quietly takes from those who do not. This video is for educational purposes only and is not tax or legal advice. Tax laws are complex. Always consult a licensed CPA or enrolled agent for your specific situation before taking any action. Form number 1. This is the most ignored form in the entire IRS catalog and the one that puts the most cash back into your monthly budget the fastest. Form W4P, available free at irs.gov. It controls how much federal income tax is withheld from your pension, annuity, or IRA distributions every single month. Here is the problem. When most pension programs and IRA custodians set up distributions, they either withhold at a default rate that is almost always too high, or they use a generic calculation assuming you have more taxable income than you actually do, so every month they hold back more than you genuinely owe. Then in April, you receive a refund, and that feels good. But here is what that feeling is actually costing you. That money was yours all year. You simply gave the government an interest-free loan for 12 months. Consider a retiree named Harold. He is 66, single, living in Georgia. He receives a $38,000 annual pension. His custodian withholds 10% automatically, which equals $3,800 annually. But because Harold is 65 or older, with the additional standard deduction for seniors and the new senior bonus deduction, his actual federal tax liability sits closer to $1,400. That is $2,400 he loans the government every year for free, $200 every month that should be in his bank account. Form W-4P is how he fixes it. He downloads it from irs.gov, completes the withholding worksheet, and submits it to his pension administrator. His withholding adjusts the very next month. That is how quickly this form works once filed. Form number 2. This one applies to anyone collecting Social Security. It determines whether the government holds your money for an entire year or whether you receive the correct amount deposited every single month. Here is something most seniors do not know. Social Security payments arrive with zero federal tax withheld by default, not 5%, not 10%, zero. For some seniors, that is perfectly fine. If your combined income is low enough that none of your Social Security is taxable, zero withholding is correct. But for millions of seniors whose Social Security is partially taxable, that zero withholding creates a painful surprise every April. They owe more than expected, sometimes significantly more, and in certain cases, they also face an underpayment penalty on top of the tax bill, all because they never knew Form W-4V existed. Form W-4V allows you to select your Social Security withholding rate. You have 4 options: 7%, 10%, 12%, or 22%. You pick the rate that most closely matches what you actually owe. This matters in both directions. Some seniors are underwithheld and face surprise bills in April, but others are significantly overwithheld, having chosen 22% years ago when income was higher, now overpaying by hundreds monthly when their actual rate is far lower. Consider Dorothy, 70 years old and married. She and her husband both collect Social Security. Their combined benefit totals $34,000 annually. Her husband set up 22% withholding years ago when income was higher. Now their actual effective tax rate on that Social Security income sits closer to 9%. They are overpaying by approximately $2,200 every year. That is over $180 monthly. That belongs in their checking account right now. A new Form W-4V sent to the Social Security Administration corrects it immediately. You can submit online through your My Social Security account at ssa.gov, mail it to your local office, or deliver it in person. Form number 3. This is the form literally built for you, Form 1040SR. The IRS created it specifically for taxpayers age 65 and older, and millions of seniors still file the regular 1040 every single year, completely unaware that a version designed for their situation exists. The 1040SR features larger print throughout, which has genuine practical value. But what truly matters is what is built into the structure of the form itself. The 1040SR contains a dedicated section for calculating the additional standard deduction available to seniors 65 and older. It presents a cleaner layout for reporting Social Security income and pension distributions, the 2 most common income sources for people in your age group. And it includes built-in sections for the senior bonus deduction that many tax preparers and software programs fail to flag automatically on the regular form. You can technically claim everything on the standard form, but the 1040SR places the deductions and income categories most relevant to your situation directly in front of you. If you use a tax preparer, ask one specific question before signing your return. Are you filing my return on Form 1040SR? If the answer is no, ask why. If they cannot provide a clear reason, that warrants further conversation. If you file using software, look for the option to switch to Form 1040SR before submitting. Most major platforms support it fully. Form number 4. This is the form that prevents you from being taxed twice on the same dollar. Retirees with IRAs are quietly losing tens of thousands of dollars to this issue. not because of anything illegal or complicated, but because nobody tracked a number that should have been documented years ago. When most people contribute to an IRA, those contributions are tax deductible. You deposit money, it reduces your taxable income for that year, and you pay tax when you withdraw later. That is a traditional IRA, and the treatment is straightforward. But some people, particularly those whose income in certain years exceeded deductibility limits, made what are called non-deductible IRA contributions. They deposited after-tax money, funds they already paid income tax on when earned. If nobody tracks that after-tax amount, called your IRA basis, then when you begin taking distributions, the IRS treats every dollar coming out as pre-tax money and taxes it again. You pay income tax on the same dollar twice, once when you earned it, once when you withdrew it, and you may have no idea this is happening. Consider Robert. Throughout his working years, he made $45,000 in non-deductible IRA contributions. He never filed Form 8606 consistently, and neither did his accountant. Now he is 68, taking required minimum distributions. Because no documented basis exists on file, his custodian reports the full distribution as taxable income. He is being taxed on $45,000 he already paid taxes on at a 22% rate. That equals $9,900 in taxes he never should have owed. Form 8606 is how you document your IRA basis. You file it with your annual tax return for any year you make a non-deductible IRA contribution. And if you made past non-deductible contributions without filing this form, you can submit amended returns to establish your basis going back to those years. This form also matters critically if you have ever done a backdoor Roth conversion. Without Form 8606 on file, the IRS has no record the original contribution was non-deductible. The conversion appears fully taxable when it should not be, and you pay taxes twice on money already taxed once. Form number 5. This is the most powerful form on this entire list. If you qualify, it could return thousands of dollars annually starting as soon as next month. And to understand why it matters so deeply, you first need to understand something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a Medicare surcharge, an extra charge added on top of your regular Medicare Part B premium that applies to beneficiaries whose income exceeds certain thresholds. The standard Part B premium in 2026 is $185 monthly for most beneficiaries. But if your income from 2 years ago, specifically from your 2024 tax return, exceeded certain levels, Medicare is charging you significantly more right now. For single filers, IRMAA surcharges begin when modified adjusted gross income exceeds $106,000. The first surcharge tier adds $74 monthly to your premium. As income rises through higher tiers, the additional charge climbs up to $443 per person monthly. For married couples filing jointly, thresholds are double those for single filers, and surcharges apply to both spouses separately. Here is the trap that catches retirees specifically. Medicare does not look at your current income. It looks at your income from 2 years ago. So if you retired in 2024 and your income that year was elevated because you worked the first several months, sold a business, took a large IRA distribution, or received a pension lump sum, Medicare used that elevated figure to set your 2026 premiums, even though your income dropped dramatically when you retired. Even though you now live on Social Security and a modest pension that represents a fraction of what you earned before, you are still paying a surcharge based on income you no longer have and will never have again. The Social Security Administration built a specific correction mechanism for exactly this situation. That correction is Form SSA 44. Form SSA 44 is a life-changing event appeal. It allows you to tell Social Security to use your current income when calculating your premium rather than the 2-year-old figure that no longer reflects reality. 8 qualifying life-changing events make you eligible: marriage, divorce or annulment, death of a spouse, work stoppage meaning retirement, which is the most relevant for most retirees, reduction in work hours or income, loss of income-producing property, loss of pension income, and receipt of an employer settlement payment in a prior year that temporarily inflated reported income. Retirement alone qualifies you. That single fact is enough. Here is the real scenario I promised at the beginning. Frank and Carol, both 67, living in Arizona. Frank retired from engineering in June 2024. Carol retired from her school district in July 2024. For the months they worked before retirement, their combined income was elevated. Frank's modified adjusted gross income for 2024 came in at $138,000. Carol's registered at $122,000. Because Medicare references 2024 income to set 2026 premiums, both were assessed IRMAA surcharges. Frank was placed in the second tier, adding $259 monthly to his premium. Carol landed in the first tier, adding $74 monthly to hers. Together, they paid over $330 monthly in combined surcharges on top of standard premiums. Their actual current income was $52,000 combined. Social Security for both, plus a small pension from Carol's district. They were paying surcharges on income they had not earned in nearly 2 years and would never earn again. Frank submitted Form SSA 44, checking the work stoppage box and documenting his projected 2026 income. Carol filed the same form for her own account. Both submitted documentation showing their current financial situation. The Social Security Administration reviewed both appeals. Frank's premium dropped to the standard rate. Carol's dropped to the standard rate. Their combined monthly savings exceeded $330. Annualized, that represents nearly $4,000 in savings. Because they filed early in the year, they also recovered surcharges paid since January. Total savings for the couple exceeded $5,000. One form each, free at ssa.gov, 20 minutes to complete, $5,000 returned. Form SSA 44 is available directly from ssa.gov. Submit it online through your My Social Security account, mail it to your local Social Security office, or bring it in person. You can also call 1-800-772-1213 to request the form by phone. The correction typically takes effect within 1 to 2 billing cycles after approval. Most seniors never file this form simply because most seniors have never heard it exists. Now you have that knowledge. That is the entire reason this video was made. Here is your action sequence before June 30th. Download Form W4P from irs.gov. Complete the withholding worksheet and submit it to your pension administrator or IRA custodian if you suspect you are withholding more than you owe. Submit a new Form W4V to the Social Security Administration if your withholding rate no longer matches your actual tax situation. Ask your tax preparer whether they are filing your return on Form 1040SR or switch to it yourself within your tax software. Have a conversation with your CPA about Form 8606 if you ever made non-deductible IRA contributions and are uncertain whether your basis is properly documented, and if you are currently paying an IRMAA surcharge and experienced any qualifying life-changing event. Download Form SSA 44 from ssa.gov and file it immediately. None of these actions requires an attorney. None requires a financial advisor. None requires anything beyond your time and the willingness to ask the right questions. You earned this money over an entire lifetime of work, Every dollar you do not claim is a dollar that stays in the system. These 5 forms exist to return what belongs to you. The only thing standing between you and that money is knowing to ask for it. Now you know.